Good afternoon, ladies and gentlemen. It's Wednesday, 1 o'clock, and we start our Modern Investing with Sasha. I would like to introduce our guests at this moment in time. We have Jim Ida, who runs wonderful chess foundation, Jim Ida Foundation, and does his own chess show on IBMTV. But today we are going to spend some time about investing. So I will not get tired to repeat my 3 rules of investment.
I know one.
Yes, go ahead.
Preservation of capital.
Wow, maybe you know second one.
Rule number 1. Preservation of capital.
And rule number 3 to see rule number 1 and number 2. And then you'll get number 3. So preservation of capital is a very important thing in our investment decision. Let's talk about basically for any novice who probably listening to us, but I don't mind to reiterate that you're available beside your real estate, your house and so on. Your only thing what you have available to yourself is your cash. And your cash could be divided into 3 substantial classes. Number 1, cash is a cash. However, that includes also gold, because gold is a heavy equivalent of cash. Gold, I'm talking about physical gold, like bullion. I'm not talking about gold shares of any companies, but the gold itself. It's a liquid. You can anytime sell gold, or you can anytime to purchase gold, right? So it's almost like cash. Now, second class of investment is a fixed income, where you are buying a bond or treasury bills or something like that that generates a defined return on your capital. It's too bad that these days 1% is a decent return. And however, you at least preserving your capital to a degree that this bond will be good. But if you're talking about solid bonds like paying 1%, most likely you'll get your money. They're well protected, I would assume. So maybe not 100% a case, but I would assume it's fairly close to 100%. And finally, the third class, it is actual investments. It's purchasing or selling. Stocks, options. Well, options is not, it's a derivative product from shares. It's deriving its value and characteristics from shares. So I cannot classify separately stocks from options. They're very different instruments, mind you, but they're sort of bundled together. Although you can do naked options or spreads or something, some other wonderful combinations without even touching the stock. And I know a few people who are doing exactly that. They don't have any stocks in their portfolio. All they do, they're, for example, buying and selling simultaneously calls or puts, depending on their outlook on the market, and depends on their strategy or market movement. They will either win or lose, but they're not exposed to the stocks themselves. Okay, if you know all that, to make decisions about allocation of capital, whether to put it in cash, gold, or into T-bills or bonds, or into stocks and options, that's very crucial decision an investor must make. And I may have some opinions on that subject, but I feel that I'm not qualified not to provide advice. I never provide any advice to anybody, but even to discuss it and make my point more or less scientific. I just don't have a capacity of doing so. I may give you certain figures and certain my own observation on market economy and so on, but you have to derive the decisions yourself. I will not be able to do it. I have difficult time to do it even for myself. Um, for example, I hold very little cash at all times. Although today I hold more cash than ever, and I don't like it. But I think that this present situation dictates that, and I always sort of I found myself at the positions when I'm trying to justify holding so much cash as to if market will allow, I can buy quality stocks at lower price. It could be so, but I'm not even sure that that's the case. I think I'm holding cash simply because the exposure to okay, so sorry, fixed income. I don't I don't hold any fixed income in my portfolio simply because 1% return is something that I cannot stomach for psychological reasons, and therefore I can't own something that brings me 1% return. I don't know what to say. Maybe my religion doesn't allow that. What else can I say? And then you're going right into stocks and options. So in these days and age, I think you're investing into stocks and options just by default. There's nothing else to do. I mean, it's almost like in chess position, you have the only move, the only legal move. And you obviously have to make that move. In fact, that move may be winning, but that never mind. It's the only move that you can make in a position. So here I am. I'm forced, even if I don't like it. Well, it happened to be that I like it, but if I wouldn't like it, I would still have to do it. So that's kind of an interesting time that we live now. So to make the first assumption is that you're forced, whether you like it or not, to invest into stocks and options or both. Number two assumption, you have to understand what's happening with the economy to see whether you see if it's all stock market like S&P 500, whether it's booming and it's going higher and higher, and that's on your side, and you can participate in that, or it's maybe at dangerously high levels and may collapse from there. My rule of thumb is I'm prepared that in 7.5 minutes, market can tank 5,500 points on a Dow. I don't exclude that possibility. It's always there. Whenever I see that the Dow, many days, Dow is opening at a very high level, and then during the day it keeps sort of going around and sliding slightly lower, and you don't know how it will open next morning. It may open 500 points lower. I mean, there is nothing like that. Now, also, the stock market, the money market makers and professionals, they're doing now funny things to day traders, if there are still any left. What they're doing is they're getting the stock opening much higher than it's closed in the evening previous day. It's opening way much higher. So people are, okay, that looks good. They're jumping into the stock. And then during the day, it keeps sliding lower and lower and lower. So if they're day traders, indeed, they have to buy it probably at the end of the day and take their losses. And I don't know what else they can do in this situation. Or just wait for next morning. Some of them probably will not have a good night's sleep. Probably they will be watching futures all night to see whether they will survive or not. But that's the reality of the game. I'm not sure that there are a lot of day traders left. A lot of them were gone, and with the new traders, they are a little bit more sophisticated than that. I hope so. Um,
Would you say that day trading was a fad?
the day trading,
Yeah.
it's
It
an
got very
interesting thing.
popular and then it got unpopular.
Well, the day trading was very big in the end of 90s before this so-called hyper
.com bubble.
boom and the collapse, and we all
Yeah.
know that. But the funny thing is that there are a lot of very good traders who, for example, they like certain stock and they decided to buy it. Usually, in your first 15 minutes after you were executed, you know you're making money on that stock or you're losing money. Normally, it's first 15 minutes. You don't need to know anything more. So a lot of them then doing this. If stock went up and they were right and they are making a couple of $100 here and there, maybe more, they liquidate position and they're happy. Okay, the $200 buying dinner, it's not so bad. Nobody get broken before selling too soon. Fine. Now, if stock went down in your first 15 minutes, so now you're losing a couple of $100 or more. Now you becoming a long-term investor. Okay, now you start to learn about the company, annual reports, financials, balance sheet, and you know about this company just as much as anybody in this universe. And then you're becoming an expert in that stock. You can lecture. You can actually go on a tour. You can write the book about that stock. And just because you are taking $200 loss, that's happened to many people. So when they're buying the stock, and I ask, one friend of mine does exactly that, and I ask him, so what's your outlook? He says, well, in first 15 minutes, either I will make some money or I will become a long-term investor. That's an answer. Okay. I don't have any problem to become so-called long-term investor as long as this stock is paying dividends, and the more is the better. And if I can write covered calls against this position, so even the stock will go down a point or two or so. It will be offset by dividends here and there. It will be offset by premiums that I'm collecting from selling covered calls. So I'm content that it's a sound company. Not that I'm against long-term positions. No, I'm not. I do have actually long-term positions in those stocks. One of them I always give you the name Altria, which makes Philip Morris cigarettes. And I always say that, well, look, as long as they're paying dividends, in fact, believe it or not, they increased just about a week ago. They increased their dividend. It was paying 7.5%. Now it's paying 8 points, some 2%.
Yeah. I noticed that because you mentioned it before, so I've been tracking it.
Oh, okay, good.
Yeah.
So with the and I'm selling all the time covered calls. I'm sold today, by the way. I got bored and I did funny transaction. I pay very low commission, so I don't even count the cost of commissions on my account. But what I did, absolutely incredible thing, and I'm actually made a couple of $100 doing that. I sold a January 42.5 calls, collected some premium, and now they become somewhat cheaper than I sold them, a couple of $100 cheaper. So I bought them back and sold also 7 calls. August 23, the same 42.5 calls. Now the stock is trading 41.68. So if the stock will go, although, because it's August 21st, of course, I didn't collect a lot of money, just $1 per call, but for 7 calls, it means $700. And now it's like in chess when you're trying to calculate your combination. So obviously your number one question comes August 21st. So there are 3 scenarios. The stock is the same. The stock ran away with now it's $44, for example, and you sold 42.5, and or it went down to 38.5 or something, right? So you already know, I already know what I'm going to do in each particular situation. Okay, scenario number one, it went down to 38 and a half or something. So I sold 42 and a half calls, collected $2. So actually, my cost now 39. Now, I'm not going to go backwards and tell you the story how much dividends I've already collected and how many calls I've sold or so on. Leave it aside. Let's consider that I opened brand new position today. Okay, so now I'm a little bit losing. It's a paper loss. I don't have to assume it. Actually, I will collect some dividends before I believe August 21st. And let's see if the stock is 39 and a half. Now my cost. I will sell probably November calls. Again, same. I'll probably do the same 42 and a half, and we'll collect another maybe maybe two and a half calls for each call. Okay. So I'm still in a game, nothing terrible happened. And the stock is going same. Then I just collected premium and will sell further calls. However, the stock goes to $45. Now, here I have to make one of two decisions. Number one, just get rid of stock and let people take it out of me at 42 and a half. Plus, I've collected some premium calls, but most likely I will buy back at loss. So I've collected only $1. I will buy it at $2.50. So I will lose $1.50. But at this same time, now I will sell, say, November, but not even 42 and a half, probably $45 calls because the stock went higher. And I would like to protect my position in that stock. I really don't want to sell it because of dividends and calls rising and so on. How, Jim, do you feel this strategy? Does it make any sense to you?
Well, yes, it does. But you went a little fast for me, in the sense that I have been traditionally buying stock, and I think you did this with your company as well. Is that you bet on it's going to continue to exist. You bet that the company is not going to go bankrupt, is not going to go out of business. So you look at a solid company, and then you look at the dividends that it pays. So you think the company is going to be around. You're going to collect those dividends. And maybe it'll go up. So where I'm having trouble following you is on how you're protecting your position by selling the options. And so if you can go over that again for me, I would appreciate it.
Okay, sure. So let's play very easy numbers because 42 and a half and 75 cents. It's all a little bit complicated. It's very simple for me because it's all sitting in my head, and then I calculate extremely quickly and so on. Okay, let's not forget about all that. Let's see, you're entering brand new position. You never had Altria Group, and you decided today is the day. Finally, I have to start my position at Altria. Stock is $40 a share.
Okay.
First of all, you look, just spend no more than 10 minutes just to see what's the business of the company, what is their balance sheet, and but most importantly, how their stock was traded in the last year and the last 5 years, okay? Just to get some ideas. Also, take a look again, probably 20 seconds is enough, on their dividends history. And especially a very important thing is that they recently, last week or so, they increased their dividends. Well, does it make sense that a company which is about going out of business would increase its dividends?
Probably not.
It's possible. No, it's possible. Very unlikely, though.
Right.
Highly unlikely. So it is highly unlikely. Okay. Well, let's see that the stock $40, their downside, in my opinion, is no more than $33 per share. It's not going to go in the foreseeable future below 33. How high it could go? Well, a year ago or so, it was $56 as high. So let's assume that it will probably touch that level or close by. The dangerous thing, if they will touch it or try to get there, it will get up to, say, $54 and will never cross 56, but it will start falling down. That's very, very pessimistic scenario. But if you bought stock at 40 and it's trading at 54, you're not complaining either. Okay.
No.
So you're still okay. You're collecting dividends, and the life is beautiful indeed. Now, let's now come back to covered call situation. If you bought stock at $40, of course, it probably will go higher. You hope, maybe. It is possible scenario. Or it could stay the same for a while, or it can go lower. If you will sell with a stock bought at 40 and you sell simultaneously, in my brokerage account, I can do it as one transaction by the name covered call. So it is one transaction, and which makes it easier on the commission. So, and it also time-wise, you see, if you do it in two transactions, actually you can do well. You can purchase stock, and stock will go a little bit higher, and then you sell calls. Your transaction will be more effective in a way, but it could be an opposite situation as well. You can buy stock and stock will go slightly lower, and then you will not collect as much premium in covered call. So I prefer do it as a simultaneous transaction. Okay, as one transaction. Okay, so what you collect per call? Okay, let's assume you have 1,000 shares, so you can sell 10 covered calls because one covered call is 100 shares.
Right.
Let's assume, of course, every expiration month and strike price, they have different prices. So let's see on, I'm not going to share screens and go into cost of all the calls, but let's assume that, for example, 21st August call, say $40 call, will cost, say, $2, okay? So by selling that call, you're collecting $2, which is great. So now your cost of stock is only $38, not $40. You spend $40 and you collect $2. So it's 38. So now as long stock is above $38, you're not losing any money, even on paper.
Right.
You're in the money. If the stock will stay the same at $40 and comes 21st of August and nothing else happened, your $2 premium is yours to keep. So in a way, you just made $2,000 income without actually doing anything. Some.
And fairly quickly.
Yeah. It's less than a month, actually, much less. 3 weeks, and you were in the money. Now, the problem is, okay, two problems. Okay, one problem is discussed. Stock will go down to $36. Okay, you are now in, it's paper loss that you're suffering now. Let's see, 21st of August. Yes, you keep the premium, $2, but stock is only $36 a share. Now what to do? Well, guess what? You can sell further $40 calls to collect even more premium, although it's not going to be $2 anymore, unless you will sell very, very far away, say January or even April position. Then you can collect even more than $2, but you don't want to play that long. Why do you need? Because you can actually sell options almost every month. So why not to do that? So. But again, you don't have to sell $40 call. Maybe you can sell $37.50 call and collect much more premium than for selling $40 call.
Yes.
So you're selling 37.50 and collect, I'm not sure, say maybe $1.50. Let's assume it's $1.50, so you collect $1.50. It's another $1,500, yours to keep. And now you see what's happened next. If stock will close of, say, October or whatever you sold September call, let's see it's closes at 37.50. You keep all the money. You collected $2. You collected $1.50. So your price of stock is only 37.50. And let's say it's trading at 37.50. That's fine. So you're not losing any money. Your dividends are coming in. And now you can sell another who knows, 37.5, or maybe even $40. 40, you will collect less money, but you will give yourself a little bit more upside potential. So now you're sacrificing income for a longer outlook on the stock, which you bought at $40. So you had certain calculations in mind that there is a chance that it will go maybe to $50 and over. So you don't want to forego this opportunity. So you still keep the stock, you are selling covered calls, and you are collecting dividends. How about that explanation? Does it make any sense?
Yes, that makes a lot of sense to me, and I understand what you've explained. What if the stock goes to 45?
Oh, after you sold the $40 calls and 37.5. Okay, if stock goes to 45, and I would assume it continue to pay its juicy dividends, so most likely you want to keep the stock, right? So you are buying back the 37.5 options that you sold and which are still in play. In this scenario, there are two scenarios. Number one, you may buy them at a loss.
Right.
But it's a paper loss because you immediately, or even in one transaction, it's a called vertical or calendar call. Calendar call means if you're going for the same strike price, 37.5. However, if stock is 45, I wouldn't sell 37.5. You know why? It's a little bit, it's an overly pessimistic outlook. You're collecting juicy premium, but there is very little upside because if stock will continue to go higher, you will buy that at loss. And you know what? There is something else. When you're buying so deep in the money or selling deep in the money calls, there is much less liquidity. There is much bigger spread between bid and ask. So you will start accumulating trading loss on bid and ask spread. Right. And I don't like that situation. I don't like illiquid options because you will be punished by huge spreads between bid and ask. So I wouldn't recommend. So if indeed stock will go to 45, I would simply buy back even at a loss. But don't forget that you're making money on stock, so you shouldn't be too worried about the loss. You will buy it, and how to explain that. When you're selling 37.5 call, you're selling a lot of time. So it is not that 45 will be 45 minus 37.5, and that's your loss. Absolutely not, because in the price, a time build already in. So dollar per dollar, you will lose probably maybe $4 or $5, not 7.5. But then now you can turn around and initiate new position. You can sell 45 or maybe 42.5 if you are more conservative, 42.5 calls. Now you're collecting pretty good premium, and now you moved your upside from 37.5 to 45 or 42.5. So you are moving your option position depends on what underlying stock is doing. Okay, and don't forget dividends, just in case.
Yeah. So this is the idea behind a covered cost, covered call, because you're protected on the downside, but on the upside, you still have a ways of making money.
Well, you keep all your upside because as soon as the stock will go higher, okay, you have. Actually, you don't have to even wait for expiration. The options are very liquid, and you can buy your option way before the expiration time. And well, in this case, what I did today when I purchased back my January position, I bought it back, generating profit already because I purchased it for lesser money than I was paid for. And stock didn't do really much in that, but there was a time factor. Right. So the time that I was sold, I wanted to capitalize and get lock in the profit because I'm expecting that with the dividends like that, and Okay, let me give you an example. Do you know that Nasdaq 100 is especially top 6 stocks are trading at a huge premium to S&P 500, right? How long market will tolerate that, we don't know. So it is kind of a always dicey situation. I'm much more careful when I'm dealing with the stocks like Nvidia or Apple or Netflix than with Altria. So Altria is almost it's like you're on vacation. The stock of Altria. It's a no-brainer. It's
You
like
don't have to track it.
I don't have to track it. I look maybe once every 2-3 days. I mean, it's boring. Nothing happened. Dividends are coming in.
Yeah.
I spend way more time to watching stocks like Nvidia, and on Nvidia, I like Nvidia stocks. Actually, Nvidia is moving sometimes even stronger than Nasdaq 100 and S&P and anything else. It's quite volatile too. And I see that if nothing will change and there will be no complete economic collapse, which there are probably 5% that happen, but 95% is not, then NVIDIA in foreseeable future, I see it as a $500 stock. It's trading today at two, no, sorry, it's a four something. What is it? 420? No, 410 maybe. You have to take a look.
So you have to have a lot of money to get into it.
No, it's not true. I don't buy this stock. Oh
I
my
got
God,
you.
it
I
went
got
up.
you.
Okay, okay. I explained to you my play on NVIDIA, just
Yes.
so you would understand what I have in mind.
Okay.
Okay, on NVIDIA, I was watching NVIDIA which way it trades and money flow and many other things. So what I did on NVIDIA, I still do short trade. I don't take any long positions on NVIDIA. I'd love to buy NVIDIA stock, which is today worth, take a look, what is it, $418 a share. If I could buy it, for example, at $405 a share, I would be a very happy man. But how to do it? If I will ask you, Jim, please sell me some NVIDIA at 405,
I won't.
you won't. You will tell me to go to hell. And you will be right. You will be absolutely right. I would do the same thing. But there is one way to do it. What I did, I sold yesterday 2 puts, exactly 212.5 puts, expiring this Friday, a day after tomorrow. You know how much I collected for each put? $7. It means $700 for each. So now what's happened is I have an opportunity if the stock will stay until Friday this week at 412.5 and lower, I will be exercised. And I will get stock at 420, 412.5. But I collected $7 premium.
Right.
412.5 minus 7, it's $400.05.5, right?
Right.
So stock which is trading today at 418, I have an outside chance to buy at $405.50. Most likely, it's not going to happen. Now, would I cry? Not much. You know why? Because I collected 700 per each put I sold. So for my troubles, that I did not acquire the stock as cheaply as I really wanted to, I was paid for my struggles. Okay, I struggled, I paid, I did the work, I was paid for my work. Was I?
Yes.
Here we go. Here we go. I did not touch the stock. However, I will, and I'm still exposed to NVIDIA
Sure.
because if NVIDIA tomorrow will collapse to $395 a share, which is possibility, I will buy the stock on Friday. I will be assigned to buy the stock at $405.50. Okay? How bad is this for me? It's not desirable scenario, but
But
like in chess, you're planning combination. Let's see, you play your move, and your opponent has 4 or 5 replies, and you have to analyze what's happened in each case. Okay,
right.
here is what's happened in my case. If stock will go down to 395, and I acquired it at 405. First of all, I will hold shares of Nvidia, which is a high quality stock. Anyway, you look.
And you betting on it.
The only thing is what I don't like about Nvidia, it pays very little dividends. But in high growth stocks, it's a typical situation. So now to sort of offset my paper loss, it's a paper loss, but it is a paper loss. What I'm going to do, I will turn around and sell probably 410, say September, probably even October calls, where I will collect a massive premium. Probably it could be maybe even $20 per call. I will grab that premium. So my share price will not be anymore $405, but rather $385. And I will be sitting on this position and write this sold calls until such time as these calls will become worthless or stock will be taken away from me at the predetermined price. So again, it's not the end of the world. That scenario that I described, it's not. What could be really bad if the market will collapse in these 2 days, tomorrow and Friday. Actually, I'm a little bit scared of tomorrow because tomorrow will be probably a job report or so on, and there's another trillion people out of job. Okay, that's a little bit unpleasant situation, but it's already happened so many times that I'm not sure how it will affect. See,
Right.
the problem is again when you actually you confiscated your fixed income 1%. That's all what people will pay you, and your cash is not earning anything anyway. So you're forced to be in stock. So many, a lot of this investment funds and pension funds, and call them any other name, they are in competition with each other. So they all have to go close their eyes and keep buying Nvidia and Microsoft and all this stuff. You know what's interesting is that the 6 stocks, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, they represent 24% of S&P 500. Isn't it insane? So, so 494 companies, they represent only 76% of S&P.
Right.
It's never happened like that before. And you know what? Yesterday, no, not yesterday, a week ago, about Thursday, I think, there was one day that all the tech stocks took beating, including Nvidia, by the way. And I was already at that time started to plan my action. So what's happened is that they made some noises on CNBC that all the tech stocks overvalued and it's time for quality and so on and on and on. Okay, so they pushed away all the day traders and some people who are buying stocks on margin or so on. So they took them to cleaners, but it's happening every once and there. So it's part of the game. Okay. Um, and then in a day or two, all the stocks were back in favor. Now is the time. Look at Amazon, and they're so wonderful. Amazon is trading, if I'm not mistaken, 31 times its book value or income value. I have to remember. It's a forward price per earnings, 31 times. it 37. It's actually Microsoft. Sorry, I was not fair to Amazon. Amazon is 128.
Yeah.
Okay. And Tesla.
Oh,
I don't want to even talk about Tesla. No.
please don't.
As we all know, Tesla is more valued than Toyota, Volkswagen, the General Motors, and Ford, and the Fiat Chrysler put together. Okay, you can probably trade Tesla. You can probably acquire Alaska together with Greenland and a couple of more countries together. Actually, I made a nice comment about that. Why it would be so good for United States to acquire Greenland, because United States could open all its beaches without without any fear of people going sick or so, because there are no people, there are no beaches.
Golf courses.
Yeah, okay, you can go there and play golf against yourself, maybe. Yeah.
But Sasha, are you happy today because all the markets are green?
Yeah.
So green is your favorite color and red is not.
Well, you see, it's hard to say. With my positions,
I know.
red is just as good. I mean,
yes, I know.
If market will go
to, yes, and I must say, Sasha, that you're teaching me why, because the Dow is not the economy. Our economy is having a horrendous time, but the stock market keeps going up. So what's the disconnect? Well, people don't have anywhere else to put their money. They're not going to settle for 1%.
I almost agree with you. It's not the people who don't have the money to put in. People don't have any money. More than 50% of households in the United States, as you know, they can't scrap together even $400, right? So these people are out of the market, period, full stop. So the people who do have money, all the pension funds, investment funds, or so on, and pension funds, if money has not been stolen from them, so they invest all the rest of it and trying to make meaningful returns, so they would have something to steal at the end of the day. So that's actually they're trying to in a way to enrich themselves, because they're making a lot of money, so they will have something to steal. If they will not make this money, there will be nothing to steal. So that's a fool's game.
But isn't that why all this money is concentrated in these few stocks? Because people
Exactly, because there are a handful of companies which are equal to these big six. These big six are they're sitting on a world-class, state-of-the-art technology, execution. They're fantastic, each one in their fields. They're leaders of their fields. The only problem is, but which makes their stock even higher, is that they don't pay any taxes and keeps all their money outside of the United States, as you know. So that makes them even more valuable. So the company makes tons of cash, keeps their money away from a taxpayer, from Congress, and from anybody else. And so we see simultaneously is that this company are becoming richer and richer and more powerful, and U.S. government is going to deficit trillions, another trillions, $5 trillion, $15 trillion. Now nobody knows anymore what is the U.S. debt. What is it? 25, 26 trillions, 29 trillions? Do you know?
I'd have to look. I'd have to look every day because it changes.
You have to look every half an hour because and you see, with so little taxes being generated and so much expenditures, and they're making noises of infrastructure rebuilding or so on, who has money to rebuild infrastructure? But tell me, Jim, it's a nonsense. You have to dismiss it outright. There will be no infrastructure, so there will be more debt, but very little infrastructure, and the money will go to people who don't have food on the table. But these people will immediately go to Las Vegas to gamble this money, so there will be still no food on the table. The money will be gone. And that's a vicious circle. And then look at the real estate collapse, which is either already there or it's coming. When people cannot pay their rent,
Yes.
period. So many, how many, what, 20 million households can pay the rent. Okay. Guess what? People who cannot pay the rent or refuse to pay the rent, which is even worse. However, let's take it somewhere. It doesn't actually matter at all. So the landlord, he cannot service his mortgage because he cannot collect the rent. So if he will not collect this mortgage, and now actually there are new rules of eviction, so probably most likely he cannot evict his renters, and the mortgagee cannot evict the mortgage holder. Okay, so now we're living in a very interesting situation. So the renters are not paying the rent. The owner of the building cannot pay his mortgage, and neither of them can be evicted. So he's still sitting on its property, which he doesn't collect anything. So his mortgage is going higher and higher through the roof. In fact, he will never, ever in his lifetime, will be able to reconcile and pay off his mortgage. Or probably if he will be evicted at the end of the day. The only thing is, instead of usual 2 years, it will take probably 5 to 7 years. But we know outcome. Actually, he will be a fool to ever pay his mortgage, because the result we know, he will be evicted. And actually, with every month, there will be less and less equity left. So in about 5-6 months time from now, there will be no equity. So he will be a fool, even if he will start collecting rent, which is highly unlikely. But even if he will be a fool to make mortgage payments. So he will be just sitting on this property. He will be very lucky to collect any rent at all, but hopefully he will. So the most likely scenario, he will put his money in his pockets and get into his car, drive to Las Vegas, and try his best over there, because he has no equity in his property anyway. So that's how it goes. So if this is something what's coming, then what's going to happen with the stocks? The only thing is, yeah.
You're depressing.
Oh well, I'm so sorry, but don't even think that in Canada situation will be much better.
Okay.
Don't even think about that. The only thing is, in Canada, everything on much lower scale.
Sure.
So if although I must say, you know what, Canada doesn't look that bad, because of the U.S. The deficit of US is what, 20, I don't know, maybe 26, 28 trillion dollars. So in Canada is 1.7 trillions. So even if you will multiply it by 10, which is a respective sizes of economies, so it's Canada's deficit would have been $17 trillion, which is still less than 26 or 28 or 10 trillions US.
Right.
Still nothing to write home about, right? But
No.
still, a little
money.
bit more tolerable. Yeah, it's all money anyway. But see, Canada doesn't have that freedom to accumulate so much debt. I mean, it accumulated an incredible amount of debt simply because of the coronavirus situation. I mean, in Canada, all numbers are so much smaller than in the US, not even 10 times, probably 20, 25 times more. See, remember this scandal with our Prime Minister, Trudeau. What the scandal is that some charity, whatever, paid his mother for speaking fees in last 3.5 years, $270,000. So how dare he is, how he could do it. But I'm thinking about what a poor woman, she made $270,000 in 3.5 years. What are we talking about? The poor woman. If she should just take him apart and just kill her son for doing that. But there's a huge scandal. $270,000. Oh my God! What was the train robbery of the century?
Oh, yeah. It's got nothing on the U.S.
No, U.S. Would you bother to even look at something as $270,000?
Oh,
You
no.
would waste. You would have to pay a lawyer $500,000 even to look at that. 270,000 in 3.5 years. Just go
Chump
away.
change. Chump change. I carried that in my pocket.
Absolutely. Okay. You really bothered by that. Okay. Give me a retainer, please, of $500,000 for me even to look into it. And then we'll start talking. No, that's absolutely incredible proposition, and yeah, I feel sorry for. Actually, I feel sorry for his mother and for our prime minister, for both of them. Anyway, that's a big scandal. So, look, I don't want to sound overly pessimistic, but I would be a fool if I wouldn't know these figures, if I wouldn't consider the possible scenarios, and if I wouldn't tell my listeners about even a possibility of this. So if I sound overly pessimistic, sorry. My investment decisions may even contradict that, but they contradict not because I'm trying to outsmart myself. It's only because market is always right. And if you see that all these bloody stocks, Nvidia and Microsoft and Alphabet and all others, and Alibaba or whatever, if they're all going higher and you're not there, so somebody else will be there. So you're not going to make this few $1,000s here and there. Somebody else will do that.
Yes.
So,
and you've got your cash in your mattress. That's not helping. You've got to play the game. You've got to get in
well,
if you
actually,
want to.
it's a good point. Tomorrow at 11 o'clock, I have delivery of a new state-of-the-art mattress. So I will have to relocate my money. Yes, I have to do exactly that. I'll be busy tomorrow at 11. No, yeah, that's a true story. So you see, it's a funny thing. You almost do investments by default. You simply do it because the market is there and it's telling you that I'm going higher. So what you do, you can't fight the market which is going higher. What, are you going to short the stocks? Absolutely not. The only thing is that I always keep some kind of, I would call it a hedge position, and I'll tell you what it is. Exactly. I initiated a few days ago, last week possibly. There is a certain, it's not even a stock, it's the derivative by the name T like Thomas, ZA. It's a triple short index on Russell 2000 stocks. So the thinking is, my thinking is, that neither Nvidia or Microsoft are all these giants. They're not part of Russell 2000.
No.
So if there will be collapse, most likely Russell 2000 will suffer, and only then S&P 500, and then 100, 100, and all those giants, wonderful stocks. So if that's the case, and they could even continue to go even higher. As I said, I wouldn't be surprised Nvidia will be $500 a share in next maybe even months and a half, maybe even before that. However, just in case I'm wrong on Nvidia and everything else, and the market will tank actually quite sizable, then because it's inverse index, so if the market will fall, the TZA will go higher. Do you appreciate that situation?
Yes.
So it's inverse 3 times.
Right.
So if the market going up, that index is going down. Actually, I want to tell you something interesting about TZA. Of course, when it was a market collapse in March, TZA was extremely high. And you know why? If you look at it calls direction daily small cap bear 3 times shares. Okay.
Okay.
Now it's down today. It's 1855. However, let me look at say 6 months chart. It was in April, no, actually in March. It was as high at $103 per share. It's today 1855. It was 103.
Because the markets are down.
Because market collapsed, and of course the Russell 2000 as well, and so on. Okay.
Right.
So what I did, I don't really want to buy even at 1855. I mean, with the market continue higher and higher, so this index will go lower and lower. Let's admit that.
Yes.
But as a protection, I would love to have that. Just so it's a very, very small, sizable investment in my portfolio. And in fact, I will go even further. I don't own TZA. No. What I did, because the TZA is about 1855, I would like to acquire it even cheaper. Let's see, 17 and a half. I would be a buyer at 17 and a half. But how can I buy at 17 and a half something that's trading at 1855? It's tough. But you already know what I have in mind. What I have in mind is I sold puts.
Yes.
And I collected $2.70 for each put I sold.
For the premium. Yes.
Absolutely. So now, thanks to a premium, and I sold August 21st, $20 puts, but the stock was 1910 or something, right? So I collected 270. So now my cost, $20 minus 270 is $17.30. And stock today is trading 1855, in spite of the fact that the market going higher and higher almost every day, right?
Right.
So now you can appreciate more or less what I'm doing.
Yes. And you're protecting yourself if the market keeps going up, that particular index will keep going down.
Well, yeah, in a way, it's almost all my positions are hedged. Almost all. I have actually. I can tell you that as of today, I don't have any naked positions at all. For example, even Apple. I'm long August 21st calls, and I'm short July 31st calls, which expire on this Friday. So most likely I will keep the premium for this July 31st calls, and I still have upside on August 21st calls. Okay, I found one naked position, which I initiated today. Okay, my naked position is, okay, remember we discussed a couple of hours ago Alibaba stock.
Yes.
Well, I've looked at Alibaba stock. I trade occasionally options on Alibaba, and I've looked at that the stock. Let me take a closer look. Alibaba. It's a very easy symbol, Baba.
Baba. Okay.
So if you look at Baba, it's trading now at $252.30. It's up today a little bit, right? Okay. So what I did today, while being on our IBMTV, I sold. Remember, I spoke so many times. I'm tired of saying that you sold. You are selling options. You are not buying options. You are selling options. Not 100% people will agree with me on that, and that's fine. It doesn't hurt me, but that's my opinion, based on certain assumptions. Okay, you know these assumptions. Okay.
Yes.
So I sold July 31st puts, which expiring this Friday at $1.80. I sold 250 puts. So if the stock will go down to $248.20, I'm even. Anything higher than that, I'm making money.
Ah,
You agree with me?
I do.
Okay. And the stock is trading now at 252.25. So
And it
I,
looks like it's pretty much going up. So
but I wouldn't mind at all if stock will go down to say 248 some dollars or whatever, because it will give me opportunity to acquire stock at cheaper price than when it's trading today. So either way, probably most likely the way I see it, my puts will expire, and all the premium I collected will be mine to keep. So at least
yeah,
I'm compensated, a little bit of cash coming my way. What can I say? Everybody needs cash.
yeah.
Uh, yeah. And tomorrow my mattress is coming in, so so if somebody wants to buy some options from me, I will consider that. I will.
But
So
you're looking at a stock that is just going from I just did a 1 year, and 1 year ago it was much, much lower. So
what,
you're really
Alibaba?
thinking that this
Yeah.
is a good stock.
No, Alibaba is fantastic stock, and it's
Yeah.
fantastic company, by the way. It's fantastic company. So I don't mind to have that stock at slightly lower price.
Right.
As soon as if I will acquire it, immediately selling covered calls. Okay. Aren't we playing chess?
Yes, yes. And you're seeing at least two moves ahead of the other person.
I have to, because tomorrow is my new mattress is coming.
Yes.
And I
Who's
would
going to
like
pay for that? Alibaba's going to pay for that.
Alibaba. Yes, exactly the case. Yeah. Jiminy,
I understand your position much more clearly than I did at the beginning of the
that's
show.
great. That's great. Any commentaries or any questions?
Well, I understand the general principle, and it seems to be preservation of capital.
Yeah, exactly. And what I'm doing is corresponds very well with preservation of capital. I would like to add is sometimes increasing your capital is
Yes.
also something what you should be trying, but it's second. It's much very well second to preservation of capital. Because if
So you're,
you solve the problem of preservation of capital, then you look, well, I preserved my capital. What's next? Oh, next you're trying to make a little bit of money.
but you're betting on the upside and protecting yourself on the downside.
All time.
Yes.
All time.
So, or vice versa. Whatever bet you're placing, you're also placing a bet that it could go the other way.
You
So,
see, there are two things that, if you really want to understand my psychological approach to it, there are two things. Number one, I'm very confident in my powers as a trader or investor or boss. Number two, I don't listen to any noise on CNBC and some commentators, some analysts or commentators don't. Sometimes I listen to it because I want to find some interesting information, what they're talking about, but then I work with this information in my own way. I don't trust anybody. That's number three. Do not trust anybody. Always rely on yourself, on your powers, on your thinking, and always remember that all good times coming to the end, the bad times as well. The problem only is that bad times taking much longer and the good times less. And the decline of stock market is much steeper than its recovery or a new uptrend or something like this. So when it's collapsed, remember in March, market going down 3,000 points on the Dow every day, every single day, 2 days, 3 days in a row. When market is going down only $1,200 on the Dow, everybody think it's a wonderful day. We did so well. The market is holding its own. It's in the red. It's 1,200 points down, but they're all laughing. They're all happy because expected was 3,000, but it went down only 1,200, right? So relatively speaking, the market did very, very well. Now, mind you, your portfolio already liquidated and you're taken to cleaners, but it doesn't matter. It still was a very good day on the market. Okay. Um, Well, Jim, you tell me what, if any further questions you have, and I would like to prepare some interesting material on next Wednesday. Because I was thinking about discussing some option strategies, but I thought that what we discussed today may be even more important than option strategies.
Well, I would like. The way I learn, I'm kind of a visual learner. So if you did have some graphs or something like that, that would be helpful for me. But everybody learns differently. So I think that if we could focus on one particular example and show how you took positions and how it paid off or did not pay off, that could be instructive as well. Because I think people have to relate. You can relate in theory, but if they have a practical example, they can learn more. And it seems to me that I followed what you're saying, and especially because you picked a couple of stocks that I'm familiar with, and you talked about them, so I could follow everything. But what if a viewer was not familiar with those stocks? So I wonder if you picked.
I feel sorry for viewers who don't know the stocks. What I'm.
That's of course you picked famous ones. Yes.
I think these viewers have to go and buy themselves some ice cream, because doesn't matter what I'm going to talk about, it's not going to help them, not at all.
Yeah.
However, it's fairly easy. See, the problem, the practical problem, is to recreate a chart on the day when I initiated my position. So somehow I would have to go back. Let's say I initiated position of say even last week. I have to get the chart, but there is easy way to do it. If I will present a chart including last week, and to show you on a chart, okay, we were there. That's where I start my position, and then to give you my prices and so on. I'll do it next week. I have no problem.
I think that would be very instructive.
Good, good. Well, now I'd like to close my show for today. Have a great trading day today and next day and next week, a month as well. And it was Modern Investment with Sasha Star, IBM TV. See you next Wednesday. Thank you very much.